In the previous lesson, we discussed the importance of financial statements and briefly the elements that make up a financial statement. Now we will look at two of those elements more closely: income and expenses. The profit and loss statement is also commonly referred to as the P&L or income statement. The P&L is a record of the money your business received as income during a specified period of time, as well as the money your business spent during that same period of time. It can be a simple document for smaller businesses, but this doesn't detract from its value. Let's look at a sample company and its profit and loss statement. This company is Rockcastle Construction, and we're reviewing the profit and loss statement for the month of December. You can ignore the fictitious year as it is only intended to serve as an example. A real P&L will always cover dates in the past. A basic P&L will always have income, you can see here where my mouse is, and expenses shown down here, and lastly the net income at the very bottom, in this case $13,685.53. The exact categories on your P&L will depend upon the nature of your business. For example, if you manufacture goods or wish to track costs by project, then you will have cost of goods sold as you see here near the top of the P&L. Also, different industries or entity types may require different types of expense categories. Your bookkeeper or your tax accountant can help you know which categories you need. Let's scrutinize this P&L at a more detailed level. Regardless of your industry type, all P&Ls or profit and loss statements will have income listed at the top. This is usually the money you receive from selling your products and services minus any returns or discounts. For Rockcastle Construction, this represents the money they earned during the month of December for construction services, $51,241.16. I'm going to collapse that so that the P&L doesn't get too cluttered. Next on the P&L is cost of goods sold. Your business may or may not have cost of goods sold. This is the money you paid to acquire or produce your products or services, such as the cost of materials used in making a product. For Rockcastle Construction, this includes expenses such as job materials, permits for building a specific home, or subcontractors hired to work on a specific project. If you have cost of goods sold, then your next line is gross profit. In this case, $31,515.25. This number simply represents the money you made from sales, your income, minus your cost of goods sold. This is the profit your business makes before paying its administrative overhead cost. It can help you know if you're pricing your products or services appropriately. Next are your expenses. These are the expenses incurred due to simply being in business, such as advertising, utilities, payroll, rent, office supplies, and so forth. Which expense categories you have may depend on your industry. However, you will want certain categories in order to properly calculate your taxes. For example, if you incur meals and entertainment expenses, you need to have its own category because it has its own tax rules. You may choose to have certain categories so that you can make smarter business decisions, such as how much you're spending on advertising compared to how much money the company is making. On the P&L, your expenses are followed by net ordinary income. This line item tells you the money left or remaining after subtracting your expenses, including your cost of goods sold, from your income. Knowing your operating profit before tertiary items such as taxes is considered to provide a true measure of how your business is operating. As we work our way down the P&L, you'll notice a category called Other Income and Expenses. Oftentimes, CEOs or managers like to have miscellaneous income, such as maybe interest earned from bank savings account or expenses that are incurred due to taxes, depreciation, and amortization, categorized here instead of the main income or expense categories. This is because these in the overall income and expense sections can distort your operational success. Lastly, you'll notice the very bottom line is net income. As a business owner, you may actually refer to this as your bottom line. The net income represents the money your business earned during the time period of the P&L statement, in this case, the month of December. All of your income minus all of your expenses, including your other income and expenses, gives you your bottom line, or your profit. Normally you want this number to be as large as possible. Now that you understand the different elements of the P&L, you want to use this information to make decisions, such as analyzing the basic health of your business. One simple calculation that can give you great insight is evaluating the net profit margin. So once you've reviewed your financial statement, let's look at how you would use that information to calculate your net profit margin. Evaluating the net profit margin of your business tells you the percentage of profit that you generated from sales. So let's walk through an example together. Take your net income. In the previous example, it was $13,686, and that's rounded to the nearest dollar. And I want to divide that number by my total income, or sales revenue. In this example, it was $51,241. That gives you an answer of 0.2671, or if you convert it to a percentage, 26.71% is our net profit margin. You said that's great, but what does this mean? It tells you your business's profit margin. In this scenario, it means that for every dollar in sales that Rock Castle Construction earned, there was 26 cents in profit after all business expenses were paid during the month of December, or whatever time period you analyzed during your profit and loss statement. You will want to compare your profit margin over time. Higher percentages are more favorable. The ideal percentage depends upon your industry, business model, and several other factors. However, knowing your net profit margin can help you determine if you need to raise prices, reduce expenses, or maybe buy inventory at a cheaper rate. Next, we will look at the balance sheet.